Euro dollar. So the euro continues to consolidate, and there isn't much in terms of any clear directional bias at this point. Overall, the broader downtrend is intact, and a potential lower top is in place at 110.60, which would be confirmed on a breakback below the December base at 105.21. Initial support now comes in at 107.11, so a break below will strengthen the bearish outlook. However, if the market does take out 110.60, this would take the immediate pressure off the downside and open the door for a more significant correction to the upside in the euro. Sterling dollar. So cable is now consolidating off recent multi-year lows, the lowest level seen since March 2009, with the market breaking to a fresh low at 141.25 on Wednesday. At this point, though, daily studies remain in deep oversold territory, so there is risk for some form of a significant correction over the coming sessions. But in order for this to be strengthened, this outlook, a break back below and a close ideally above 141.25 would be required to get this correction going. Otherwise, deeper setbacks remain a possibility towards next key support at 140.50. Dollar yen. So dollar yen has finally taken out that critical August low at 116.30, with the market trading down to 115.97 on Wednesday. But the market will need to establish a close above that 116.30 level to open the door for the next meaningful downside extension. Until then, there's risk for some more consolidation or the potential for a correction back towards the 118.85 area. But a break back above 118.85 would ultimately be required to take the pressure off the downside in the dollar yen market. Until then, there is this risk for the market to extend declines below 116.30, below the 115.97 low from Wednesday, and back towards next critical medium-term support, which comes down into the 112 area. Euro Swiss. So Euro Swiss continues to attempt to recover after trading within a multi-week, multi-month consolidation, and the market is now closing in on a retest of the critical September 2015 peak at 110.50. A break above 110.50 will open the next major upside extension towards the 115 area. Any setback should be very well supported, while ultimately only a break back below 107.15 would compromise the constructive outlook for Euro Swiss. Aussie dollar. So Aussie remains locked within a well-defined downtrend after the market recently broke to its lowest level since March 2009 to a fresh multi-year low of 68.27 this past Friday. Those setbacks were matched on Wednesday, though the market wasn't able to establish any meaningful setbacks or wasn't able to break below that 68.27 low and has since rallied off the lows. The market has seen some intense setbacks already in 2016, so there is risk for a bit of a consolidation or a bit of a correction before we see any meaningful declines below that 68.27 low. Look for any rallies to be well capped towards the 72 handle, while only back above that level would really take the immediate pressure off the downside. Dollar CAD. So finally, a bit of relief for the dollar CAD rally, which traded up to its highest level since April of 2003, near 13-year highs for dollar CAD, with the market reversing sharply on Wednesday. At this point, though, key support comes in at 144.32. That's the low that was seen earlier this week on Monday, and a break below that level would do a good job of signaling some form of a decent correction and opening the door for potential setbacks towards the 140 area to allow for these intense overbought studies to unwind. Still, overall, the uptrend remains firmly intact, and any setback should be well supported towards 140 in favor of the next higher low and resumption of this strong uptrend. Kiwi dollar. So Kiwi has been supported on recent dips to 63.47, so the 63.50 area, although the overall downtrend here remains intact, and deeper setbacks are eventually favored back towards that May 2009, that low that we saw back in 2015, which coincided with the lowest level since May 2009. That level was 61.30. Again, any rallies from here should be well capped up towards the 66 area, with deeper setbacks favored back towards that 61.30 2015 multi-year low, again the lowest level seen since May 2009. S&P 500. So the S&P 500 has broken to a fresh low, taking out the August flash crash low of 1834, with the market extending down to as low as 1811 on Wednesday ahead of this latest minor bounce. At this point, though, any rally should continue to be very well capped, with some previous support now turned resistance at 1993 serving as the ultimate resistance point for this downtrend. Only a break back above 1993 would take the immediate pressure off the downside. Deeper setbacks are seen if the market can establish a close below 1834, which would then open the next major downside extension towards the 1700 area. Gold. So gold continues to show signs of the formation of a meaningful base following that break above 1100 earlier in 2016. At this point, a break back above recent highs that were seen at 1112 would confirm the bullish outlook and open the door for an acceleration up towards the 1200 area in the weeks ahead. Only back below 1070 would compromise this outlook and put the pressure back on the multi-year low from late 2015 at 1046.